tell you something, all that glitters ain't gold. Hey, hey.
The advanced estimate for quarter three GDP growth came in at a smoking hot 2.6% rate. But in the words of Aloe Black, all that glitters isn't gold. We're going to look at why this isn't gold, and we're going to dive into the numbers. Let's start with the GDP for the past 2 years. We can see the economy has been slowing over the past 2 quarters. So where did this surprise growth come from? Well, looking at the breakdown, we can see that PCE, aka consumer spending, has slowed down, but still remained positive overall. Note though, the spending is only growing in the services side, with the goods side being negative for just about all of 2022 so far. So the consumer is hanging in there for now, and we'll talk more about that in a minute, but the consumer clearly isn't what drove this spike. With 2.77% GDP growth, more than the 2.6% overall for this quarter, net exports are the reason our GDP didn't go negative. Which that's interesting, right? Because the US is a net importer, not a large manufacturer like China, and the dollar has been surging with each of the 75 basis interest point rates that the Federal Reserve has made. These hikes make our exports more expensive to the foreign market. So our exports should drop in the face of that, right? Here's a graphical breakdown of that GDP change. We can see 1.63% of the GDP growth was because of our export of goods. Let's look at the breakdown of this export of goods number. We first noticed that exports grew by $21 billion, while imports fell off a cliff. They were down by $113 billion. So an increase in exports with a decent drop of imports is how the economy grew. But wow, would you look at that? The capital goods except automotive category grew by $21.2 billion. What luck! That boost pushed us over the edge to keep us from being negative on the quarter. Now listen, about $3.7 billion of that comes from computers, which makes sense, right? Because the Chinese had some lead time to stock up on chips before the ban was put in place by the Biden administration. But what's interesting here is that the other category grew by $17.8 billion, just enough to offset the economy shrinking elsewhere and push us in the positive. There's nothing suspicious at all about that right before an election, right? So I dove into this. I couldn't find more information about the other category on Fred or BLS, but after much searching, I finally found it on the BEA website. Here's what they say that this category is comprised of: semiconductor manufacturing devices, railway transportation equipment, vessels except military and pleasure craft, spacecraft, engines, and parts except for military, telecommunications equipment, scientific, hospital, and medical equipment, parts, and other industrial machinery. If you know more about this category or you have a breakdown of exactly where this money went, let me know. But we're going to keep an eye on how it gets updated because I suspect that it's a little bit suspicious. Listen, before I move on, I do want to add some context to my jab about this number being suspicious. Here's a screenshot of the GDP Now estimate from the Atlanta Federal Reserve. Now, they tend to estimate a little bit higher than the final numbers. At least that's been my experience in monitoring this. But what I want to bring to your attention here is the massive spike in their estimate around the end of September. Notice how the blue chip estimates, the average of the blue chip estimates, it doesn't swing at all. So what does that mean? Well, I suspect that the Atlanta Fed found out about the surge in these other exports early. And notice how that initial spike, it lands almost exactly at the 2.6% final number. Kind of eerie, right? And then it goes up a little bit and they're over like they often are. So let's move on to inflation. As inflation has started to ease a bit, real disposable personal income went positive for the first time in a year. Here we can see the PPI and PCE measurements of inflation dropping as our economy slows due to the Fed's interest rate hikes. Have no doubt about it. Prices aren't dropping because supply increased. The government cannot increase supply. They are dropping because demand is starting to decrease, and that's by design. The Federal Reserve wants to slow down the economy. But consumers don't want to slow down. So consumers have been running up their credit card debts to fend off the loss of quality of life caused by high inflation. Credit card debt rose to $887 billion in the second quarter of 2022, according to the Federal Reserve of New York. That's up 13% on the year. This is the largest annual increase in 20 years. At this point, even Paul Krugman admits that the rebound in GDP won't last. In this article from Markets Insider, he is noted as expecting the exports to disappear as a growth driver, mainly because of the dollar's surge. Remember how in the last update, I said we would start to see an inventory recession become an earnings recession? Let's look at some earnings. Well, the tech earnings were a total flop. Meta, Microsoft, and yes, even Amazon, they're all struggling. Now, most tech companies are categorized as services and not goods. But Amazon, they sell goods. So what did Amazon have to say? Well, Amazon just projected the slowest fourth quarter growth in the history of the company. Their CFO noted that they would be, quote, taking actions to tighten our belt, including pausing hiring in certain businesses and winding down products and services. And quote, we are preparing for what could be a slower growth period like most companies. And looking at the latest blue chip numbers, we can see they are estimating, on average, that GDP will be slightly above zero. While the Atlanta Federal Reserve's first estimate from October 28th, it's 3.1%. So listen, we're headed to recession, and that means the market hasn't bottomed out yet, right? I mean, that's what the numbers traditionally tell us. Based on the bond yield curve inversions, we've got a little bit to go on the market. But on the other side, the stock market has risen after every midterm election since 1950 per Forbes. And in the article, Forbes notes that U.S. stocks have consistently earned positive returns after previous midterms and delivered an average annual return of 18.6% compared to 10.6% in all other years. And if we look out 2 years after the previous midterm elections, the average return has been a blistering 33.7%. I don't think inflation is done yet, and the economy is definitely slowing down, which means that we will likely buck the election year trend to the lower side at the very least. Let's look at some examples as to why. CNBC says that clean diesel is in such shortage in the U.S. right now that prices have went up by so much that traders are diverting tankers away from the lucrative European market because they can make more money selling that in the United States. In another report, Bloomberg reports that, quote, about 37% of small businesses, which between them employ almost half of all Americans working in the private sector, were unable to pay their rent in full in October. So what do you think? Which historic trend will continue? Will the bond yield curve inversion be correct yet again? Or will the election trend continue? Tell me in the comments below what you think will happen next in the economic circus.